this feeling like you can identify where the opportunities are for your clients and give them enough guidance with background so that they know what a 1031 exchange is. It's part of the tax code. Okay, and it allows for an investor to defer all of the capital gains taxes on the sale of their investment property. So we're going to go over what types of properties qualify in the 1031 exchange, the timing and identification rules that the IRS has. The timing is very strict, so I want you to really be aware of that. And then how do you complete this selling and buying transaction so that they don't have any capital gains taxes? So it's basically 100% tax deferred. One of the main rules under the IRS guidelines for 1031 is you can't just do it on your own. You need to use a qualified intermediary. And the qualified intermediary provides kind of an insulation to the taxpayer, who is your seller, from receiving the proceeds and acting as the principal in a regular sale. So we're providing them with this third party to guide the transaction through. Okay, so what exactly is a 1031? As I mentioned, it's Internal Revenue Code Section 1031. It's a tax savings technique. It allows a seller of investment property to pass through all of their equity and their debt into new properties and not recognize the sale as a typical sale. So as long as they follow these guidelines, they can do 1031 exchanges indefinitely, continue to buy and sell under the guidelines and never have to pay the capital gains taxes. So it makes it technically a non-taxable sale. It's allowing them to reinvest with more cash because they're not having to take a chunk out to pay the IRS. Okay. And as long as that closing happens with the 1031 exchange documents in place and a qualified intermediary in place for the closing, then it should qualify under the guidelines. So how do you explain it to your clients? It's basically just a tax thing. So they have to have, the right structure in place. It's done on investment property. It's not done on your primary residence or second homes. It has to be done within a certain time period, and they have to buy property that's equal or greater in value to what they sell. Okay, so they also refer to this 1031 as a like-kind exchange, and that term is kind of confusing for some people because they think when you say like-kind exchange or like-kind property, that it means you're buying the same kind of property. Like you sell a condo and you have to buy a condo, or you sell land and you have to buy land. But the IRS's definition is very broad about what like-kind property is. So don't be confused by that term, because as long as it's investment or income producing is what matters. So the 1031 exchange really just defers the taxes, okay? It doesn't wipe it out. It doesn't make them go away forever. It's not a tax-free transaction. It's just not recognized yet at the time of the sale. So some of the reasons that people will do a 1031 exchange, there's so many different reasons that it comes into play. You can have an investor that has multiple smaller properties, and now they want to sell those, 1, 2, 3 properties and buy a much larger property. So they want to consolidate their investments. Or it may be the other way around, diversify. They may have a large piece of property, land, or just something that all of their eggs are in one basket in this property, and now they want to diversify. They want to buy investment properties in different areas to kind of edge on the market, so they can diversify nationally. This is federal tax law, so they can buy anywhere in the United States. They can change the investment type from a non-income producing property to investment producing. It can be properties that they're using for their business, of course, and maybe they need to buy a larger one because their business has outgrown the current property. It also can facilitate future relocation. If a company knows that they're going to be moving into another area, another state, or an individual for that matter, they can start moving their investment properties through using a 1031 so that they are in a better location for management or whatever reason. So there's many different reasons for them to use the 1031 exchange. The number one benefit, of course, is that you're not paying capital gains taxes. From that sale, all of the net proceeds that come out can go into purchasing a new property, which may help them leverage more financing because they have more down payment so they can buy larger property or diversify. They're really using the IRS's money that they would have otherwise would have written a check to the IRS that they don't need to. So it helps you build wealth, real estate wealth, your real estate portfolio, relocating, and people even use it when they're thinking about retirement and estate planning. So for you as the real estate professionals, you're going to have multiple commissions. Number one, if you're working with listings that they are investment properties and these people want to purchase another investment property, you've got both. You've got the sale and their purchase. Okay. It's very valuable to them. And many people don't really understand it or know enough about a 1031 to even think about that they should be doing it unless somebody has told them. And you could be that frontline person letting them know that they have the ability to do this. We always want to involve, or suggest to them that they should talk to their CPA or tax advisor. And many times that's the person that's going to really let them know that they need to be aware of how much in taxes they're going to owe and that they probably should do an exchange. So as the intermediary, we provide a lot of services. Number one, just being available to you up front for questions and guidance, to your clients for their questions and guidance, for troubleshooting, for looking at what they may be planning to do and if there might be some issues with it. Making sure that from the beginning, the exchange is going to be done properly. So your intermediary cannot be what the IRS refers to as a disqualified party, meaning can't be their agent, can't be their CPA, their own attorney. It has to be someone that doesn't do any other service for them. Okay, so we're, a disregarded, not disregarded, but a third party entity that this is all that we do is handle the 1031 exchange. We prepare documents that have to be a part of the closing. So if you go to a closing that your client is expecting it to be a 1031 and you don't see the exchange documents there, then they've got a problem. They need to stop and, figure out what's going on and get a qualified intermediary to get documents to them. We protect the exchange proceeds. That's another very big service that we provide because the taxpayer, your seller, cannot receive the proceeds. They cannot have actual or constructive receipts. So we're protecting them from both. We set up a qualified escrow account so their funds go directly into that. You can think of it like a IRA or retirement account that they can't touch it. Once they do, it's taxable. So we're guarding it for them until they're ready to purchase. And then those funds get wired to their purchase closing. A number of the things that we do create what the IRS calls a safe harbor for the 1031 exchange. So to go back to one of the three main things you need to know about is the properties that qualify. Like I said, it's like-kind property. That's a very broad definition. It technically is property that's held for investment or production of income. It doesn't say a single family rental for a single family rental. Okay, so it is their intent and how they treat the property. The main thing to remember is they don't live in it. It's not a second home and it's not a primary residence. And another thing is that they're not flipping. because property that you buy with the intent just to fix up and sell is a different type of investment. That is something that's just creating ordinary income. It's not for long-term investment. So here's just a little example of various types of properties, and these are all interchangeable. Even a 30-year lease on land, as there's 30 years remaining on a long-term lease, it buys as a fee simple interest in real estate. So you could be selling an office condo and turn around and buy an investment in land, or single family rentals, or even shopping center, or what I have here, TIC, a tenant in common interest, which means that a person can sell something that they own 100% of and buy an undivided interest with another investor in a property, as long as it's equal or greater value and they're not creating a partnership. So one of the things in 1031 is continuity of ownership, okay? But we'll get into that a little bit more later. One of the second and very important areas in 1031 exchanges is the timing and the identification rules. So this is the toughest part of the exchange. From the day of the closing, we calculate out the timing the IRS has for the taxpayer to identify in writing what they intend to purchase and the completion date. So they have 45 days from the closing on the sale to identify in writing what they want to purchase, and a total of 180 days, or that remaining 135, to complete that purchase. The reason I say this is the toughest part of the exchange, because a lot of times people, I've seen it so many times, that they'll close and then they say, oh, I'm going on vacation. I'll be gone for 3 weeks. And then they come back and now they've only got a few weeks left to find their property and be able to be sure that they can buy it. So my best advice is that when they know they're doing it 1031, they should be looking at properties even before they close on their sale. Because ideally, what we want to see is that by the time they're giving us this list of properties, and I'll go into how many you can list in a moment, by the time they give us that handwritten list, that hopefully the first property on the list is one that they already have under contract. And maybe they've already done their inspection, so they know they are able to go forward with that closing. So they're able to list more than one, and I'll give you the rules in a second. But what I want to point out is this 45-day identification, the IRS just says they have to provide a written list. They don't say you have to be under contract. But if you're not under contract by that time, then how do you know you can even purchase what you put on the list? And as of day 46, you cannot change the list. So you're stuck. If you can't buy what's on the list, the exchange fails. Okay. So, and if it's pre-construction, you have to remember they have to receive it before this 180-day period is up. They have to receive title to the property.
Hey, can I ask a question? Like, for instance, like, let's just say you're selling a property for $1 million. Do you have to buy another property for $1 million, or could you, let's say, buy 3 properties that are worth $1 million?
Yeah, you can diversify. You can buy as many properties as you can afford, as long as in the end you balance the exchange, meaning that you've spent all of the net proceeds that you got and you replace your debt. And that can be divided up any way you want. So you can sell for $1 million and buy 3.
Okay.
Okay, so here are the rules for the identification. And when we figure out this timing for their deadlines, we send out the forms to use. There's 2 forms. There's one they call the 3 property rule, and the other is the 200% rule. So under the 3 property rule, which is the one most people use if they're going to just buy one new property, okay, or even 2 sometimes. So they can list up to 3 properties on that form for any total value. You could sell for $1 million, you can have $10 million worth of property listed there. Doesn't matter. They can buy 1, 2, or all 3 if they wanted to. But if they need to list more than 3 properties, let's say that in Giovanni's scenario that they sell for $1 million and they want to buy 3. So they might want to have one or two backups on the list, just in case one of those three doesn't go through, that they have something else to go after. So under the 200% rule, the IRS says, if you want to list more than three properties, now you're limited to only, for a total aggregate value of everything you put on that list, you're limited to only up to 200% or 2 times what you sold. If you hit that 200% in total value, IRS expects you to buy 95% of the value you've listed, which you might as well just say you have to buy everything, or the whole exchange doesn't qualify. So what you're going to put on that list is going to be, the property address and the value. You're listing either the list price. If it's under contract, you list that value. If there was an appraisal done, you got to put whatever you think that the value is, market value. You can't just make it up. You would have to have something you can rely on. Now you add those up, and that's the total that cannot be more than 2 times what you sold. So if you sold for $1 million and you listed 5 properties, you don't want to have $2 million worth of property there. You want to be just under it. Okay. So that sometimes is difficult, especially, depending on the values you're buying. So what we're doing in the exchange to avoid having there be any taxable, what we call boot, or what the IRS calls boot. Boot is anything in the transaction that is going to be subject to capital gains taxes. Boot would be cash that they received and they took out of the exchange. Maybe they received the deposit and they said they don't want to put the deposit back into the closing. Okay. We always advise that they put it back into the closing, and that if they want cash out, they wait till the exchange is done and maybe hadn't spent everything that was in the account and take it out at that time. But part of our job when we're reviewing a settlement statement for the closing as the qualified intermediary is we're looking to see if there are any taxable items there. Those taxable items could be, if it's a multifamily, could be prorated rents, security deposits. It could be back HOA dues. Anything that's considered a recurring expense is something that technically doesn't qualify for the 1031 as an expense. Anything that's non-recurring, like commissions, attorney fees, title expenses, everything you pay on a one-time basis in a closing is fine. That's not going to be a problem. So we're looking to see if there's cash. Seller financing is something else that we have to, there's another way to deal with that, which if you ever have it come up, you just call me because I'll explain that process. And you'd want to be able to give this information to your client before they accept a contract with seller financing. So as long as they don't have anything taxable in the closing, they can get it, they can achieve a 100% tax deferred exchange. So again, I mentioned there's 3 main areas. The number 1 was the properties that qualify. Number 2 is the timing and the identification rules. And number 3 is what we refer to as balancing the exchange. So when they balance an exchange, we want to try to avoid boot so that they're buying property of equal or greater value, that they're moving across or up in equity, across or up in debt. So if you sell a property for $450,000 and you have $200,000 of equity, and I'm not plugging in this example any closing costs, but you can take off the top those non-recurring closing costs. And let's say you pay off a mortgage of $250,000. So they would need to buy a property for at least $450,000, use all of their net proceeds as down payment, and get a new mortgage at least of $250,000. So in this example, they're buying up in value. They're buying at $600,000. They put all of their equity in, and they replace their mortgage and then some. So they bought up in value. This would be a completely tax-deferred exchange. Now, it happens pretty frequently that people say, hey, I don't have any cash. I need to take cash out of this closing, need to pay myself back for some things. I need to pay off some debts, whatever. They want to pull cash out of the closing. Again, I say we always advise that they wait and take it at the very end of the exchange, because there's some existing court cases out there in another state that the state actually, in the court cases, deemed that the seller, exchanger, had control over proceeds. And remember earlier, I mentioned that we're trying to protect them from being seen as having actual or constructive receipt of funds. So in this case, they say they want to take $50,000 out. Okay. We refer to that as boot. This is cash boot. So here they still went ahead and bought a property for $600,000. They went ahead and replaced their mortgage with a higher mortgage to make up the difference, because they only put, instead of $200,000, they put $150,000. So they're taking $50,000 out. This is very expensive money. Okay, so this $50,000, when they report their 1031 on their tax returns, the first thing that the IRS taxes you at under capital gains is depreciation recapture. So any depreciation they had taken on the property, that portion is taxed at 25%. So if they had taken $50,000 in depreciation, they're paying about $12,000 or so for getting $50,000. So another way to do that, like I mentioned, is taking it at the end of the exchange. They will still have to pay the tax, or in certain situations, they may want to just go ahead, put everything into the replacement property that they purchase, close on it, get it rented, wait a little bit of time. I can't tell you how long because there's nothing in the tax code, but maybe they just go back and get a line of credit or a cash out refi. When you do that, it's not taxable money. Okay, and then last, another thing that creates boot is by not replacing the mortgage. This basically is where you're buying down in value. Even though you put all of the equity as down payment, so this person, again, they sold for $450,000, now they bought something for $350,000. They put all their cash into it, but they got a smaller mortgage. This $100,000 difference here is taxed just like they got cash. So that's a very, it's not a fully tax deferred exchange. It could still have helped them defer some capital gains taxes, which I'll explain also in a little bit. But there could be a couple of resolutions to this. They could be planning to buy a second property to make up the difference. They can come out of pocket with cash to buy another property, and then they, in their whole exchange, reporting the sale and maybe two purchases, now they don't have any boot left over, okay? Or another situation could be, maybe this is the perfect location, great property, but it needs capital improvements done to it. There is a way in a 1031 exchange, it has to be set up before the sale closing, but they could end up using cash from the exchange to make capital improvements and raise the value of this replacement property. So here's a little overview of the capital gains taxes. It's not just 20%, like a lot of people think, and it is based on somewhat on income. So if it's somebody that doesn't have very high income, it may be less on this capital gains rate here of 20%, which this 20% is capital gains tax on the appreciation in the property, the value that it went up over the time it was owned. There's a healthcare tax, 3.8%. A lot of people get stuck with if you're over a certain income threshold. There's depreciation recapture on a portion of the gain that's represented by depreciation they've taken over the time they've owned the property. And then lastly, if they actually sold in another state outside Florida, they may have state taxes to pay in addition to their federal taxes. So when you're talking about a 1031 exchange, there's like two separate sets of numbers that I deal with in every conversation. And that is, what is your tax liability? Your tax liability is based on how much appreciation you've had, how long you've owned the property, and how much depreciation you've taken. So you have to look at your cost basis. You paid $100,000 for the property and now you can sell it for $300,000. Well, you have $200,000 in appreciation. That's gain. Okay. So gain comes from the appreciation and the depreciation. If you don't want to pay taxes on the gain, the IRS says you need to move over all of your equity and replace your debt. So there's another set of numbers. How much cash equity do you have and what's your mortgage payoff? Okay, that's how you avoid the taxes on the appreciation and depreciation. So I have a little kind of a diagram here to help explain how this works so that you can have a picture in your mind. So, and this is also something I'd like to tack on here, that when you're talking to somebody, you're trying to get a listing, there's only a couple of questions you have to ask to know if there's an opportunity for them to do a 1031. You don't have to remember all of this stuff I'm telling you, because it's not necessarily your job to explain it, and you probably don't want to. But once you figure out if they have some gain and yes, they are open to buying another property, that's when you can say something about the 1031. So the first thing that we want to look at is original purchase price. So you're sitting at a listing and you're telling them, you've got a great property here. It looks like from, my research, the CMA, that we could probably sell it for $1 million. How much did you originally pay for this property? Oh, you paid $300,000 for it. Wow, you've earned like $700,000 in appreciation over the years you've owned it. So over that time period, here's a timeline, the appreciation had grown, okay? And over this time period, if it's a rental property, improved property, they're taking depreciation, which is a benefit under the tax code, and you don't want to let go of it because it helps you to lower your taxable income by having this write-off, okay? But it also lowers the original cost basis of the property. So over years of ownership, in this situation, I've got that they took $150,000 in depreciation over the years. So now that original cost basis is adjusted, and they call this the adjusted basis. So now it's down at 150. So you've got the difference between the 150 and the $1 million. This is all gain. 700,000 of appreciation, 150 of depreciation. This doesn't tell you anywhere how much equity or debt they have. This is how you figure out what your tax liability is going to be when you sell. Okay. Once you know this number and you see that, yes, they have some good appreciation in the property, you may just suggest, you may want to do a 1031 exchange. You should call your CPA and find out how much in taxes you're going to owe when you sell this property. And to avoid that, you can buy another investment property, or 2 or 3 properties, however they want to go forward. So when you look at this 700,000, the federal tax on appreciation is 20%. Okay. There's $140,000 in taxes right there. The federal tax on depreciation of that 150 is 25%. There's another $37,500. And if they sold an estate, I just used like an average rate, 6%. There's a lot of states with much higher. There's another 51,000. And I didn't even touch the 3.8 that they could also be taxed on. So there's a huge chunk of money here that if they just sell, they're going to be paying to the IRS. And this is actually extra cash that they could be using to reinvest and buy another property. So once you have a little bit of an understanding of this, being able to just turn your clients onto it is going to be a great value. Okay. Now, in the brochure that I have at the back of our brochure, which I'll send Giovanni, I know he probably has it, but I'll send another so he can put it wherever you can get to it, or you can always call me. In the back of it, it does give you a little form that the client or you could sit and kind of work through some just, estimated numbers to get an idea of tax liability. So again, any piece of real estate that is owned, when it's sold, the IRS is going to tax you one way or another, unless you don't have any kind of gain in the property and only losses. So residential being primary residence versus a 1031 property being investment or income producing property, they're both going to be taxed. Second homes that fall in the middle because they're not primary and they're not investment, those get taxed and they don't have any kind of exclusion or tax deferral. Okay. So the sale of your primary residence is one code section, which is section 121. As long as the person has lived in the property for 2 out of the previous 5 years from the sale, they can take an exclusion if you're single up to $250,000. If they're married, up to $500,000 with no taxes. Any gain above that, they have to pay capital gains taxes on. You can use it every 2 years that you live in your primary residence. Okay. And you're not forced to buy a new home. You can do whatever you want with the money because it's an exclusion from capital gains taxes. Again, the sale of investment property through 1031, which is the other code section, allows you to defer all of those capital gains taxes by buying new investment property. There is certain rules for hold periods and how you treat the property. So anything less than 12 months could be looked at as flipping or not really have an intent to have held it for long-term investment. So it's a good idea to pay attention to how long the property was held. If somebody just bought it to fix it up and turn around and sell it, then that's a flip. And that's a different type of investment for just generating ordinary income. So there's lots of different issues that when we consult with somebody, and all of our consultation is free, so you can call anytime or have your clients call anytime. When we're going over their transaction, there's issues that we're looking for. Do they have any ownership issues? Because in a 1031 exchange, it's all about the taxpayer. The IRS doesn't care about who we are, what we do. They see us as a number, social security number, tax ID number. Whoever the taxpayer is that's selling has to be the same taxpayer owner that's buying. So there's a continuity of ownership that cannot change as far as the taxpayer is concerned. You should have the 1031 clause in your contracts. The as-is contract, I know, already has a 1031 exchange clause in there. And then there's that other little section about assignability, which doesn't generally affect the seller. But in order for the intermediary to come in to act as the qualified intermediary in the transfer of properties, we have to get assigned into the contract. So especially on a purchase contract, you want to make sure the contract is assignable. And you can just choose that, that checkbox that says they're not relieved from liability, but it's assignable. Okay. Constructive receipt of funds. I mentioned that we're always looking for that because we want to make sure there's no boot in the transaction. And there's a lot of various things that come up outside of what we're going over right now, which is the basics of a 1031 exchange. So seller financing is one. That's an installment sale that can be handled through an exchange, but there's only certain ways it can be done. There's partnership issues. When the owner of the property is a corporation or a partnership, those are the actual taxpayers, not the individuals who are shareholders or members or partners. So that's something to, that we look into also. Related parties. IRS doesn't want us buying our replacement property from somebody we're related to. So your brother, your sister, your mother, father, grandchildren, anybody that's a blood relation, you're not allowed to purchase from, except only under certain very strict circumstances. but in general, it's a no-no. And even for somebody that is, say, 100% owner of a corporation that's buying a property where he's also a 50% or more owner in another corporation. Okay, so those are other types of issues. Now, since we live in Miami, we're hit with FIRPTA all the time, right? You know what FIRPTA is, foreign investors, in foreign investors, basically. So the FIRPTA rules require that the closing agent's going to have to withhold 15% of the sales price, not of the proceeds, but of the sales price, and send it to the IRS, because they are trying to circumvent what used to happen. And this tax act or law has been in place since the 1980s, but they're trying to stop investors that are foreign from closing on a property, taking all their funds and leaving the country and never paying any tax. So that's what this is there for. But when a foreign investor is doing a 1031 exchange, it gets a little more complicated, because there is no merging of these two tax rules. We have to try to juggle between the two to make them work together. So if you have a foreign investor and they know that they're thinking about a 1031 exchange, they need to be talking to a CPA that deals with foreign investors from the moment they list the property, because there's certain tax filings, and there's also trying to offset that withholding that has to happen. It's a little complex, so I don't really want to go into much detail here, but you're always welcome to call if you need more information. So pretty much let's see, just to touch on the different types of exchanges. There's simultaneous exchanges or swapping, which is what 1031 exchanges used to be. Many, many years ago, is that you had to trade properties with another person. Simultaneous just means that they're going to close on the same day. And unless you have Giovanni doing the sale and the purchase the same day, it's going to be very hard to make sure that the purchase can close the same day because of wires and just timing of the day. So simultaneous just means closing the same day, but it's not necessary. A delayed exchange is where we're falling into that time period, the 45 days, the 180 days. You close on the sale on one day, and you have to close, on your purchase within that time period as identified property. They also refer to it as a Starker exchange, because that name Starker came from the original taxpayer who was challenged by the IRS back in the 70s. And from his court cases came out all these rules, many of them that we deal with today, the identification and timing and all of that. And that's where our company took our name from those court cases. There's also scenarios where they have to close on a purchase prior to closing on their sale. It could be because it's more advantageous. It could just be because, their sale fell apart, and now they're already supposed to close on a purchase. And now what do? There is something called a reverse exchange, where we can purchase first and then sell. And I'll give you a couple details on that. Improvement exchange, again, that could be combined with a reverse or a delayed exchange. It just means we're going to have to use money from the exchange to make capital improvements. But the catch is that we have to take title to the new property. So it's a little bit more complex, and it does cost them more to accomplish. So just to give you a little bit more on the reverse, because it's fairly common, so I want you to know about it, is that in a reverse exchange, when we're going to buy a property before we sell, obviously we don't have the money from the sale yet. So that means the person doing the exchange, our buyer, the taxpayer, has to be able to pay all cash for that new property. They cannot own both properties at the same time. So besides acting as a qualified intermediary, we also act as an accommodation title holder. So we have to step into that purchase closing, having them deposit all the funds, which is technically a loan to us, and we temporarily take title to the property and hold it for them. We're parking the property. So now we're waiting for them to close on their sale. Once they close on the sale, we use those funds, we go back, we transfer them to this buyer or taxpayer exchanger to pay off what they loaned us, and then we transfer the property to them. That's a very, very simplified version of what happens, but just so that you know, it is something that can be done, and it can save a failed delayed exchange. It could help this person in many different ways to not lose a replacement property that they found, and they just, if they don't make the deal happen now, it won't be there. It could be that they're selling a business. They want to buy their new commercial property so that they can get that set up so that when they do close on their sale, they're ready to move their business straight, right into it. There's a lot of good reasons to use a reverse exchange. So that's about it. And I'm totally available here to answer any questions you might have. Starting an exchange is basically it's never too early to call, from the time of the listing to questions during the listing to getting an offer to once they've got the offer. You can call so we can explain, the process.
Right. Yeah, Diane, I have a few questions. Also, if you want to put your information in the chat so they can reach out to you and call you. Okay, one question is, how, like, for instance, after hearing this, I know one client I have was supposed to close on Monday. They're selling an investment property and their plan is to buy another one.
Mm-hmm.
Is it like, how much time do you need to organize this? Like, if let's just say today's, today's Thursday, and if they're closing on Monday, do you have enough time?
We do. I have to really push because my corporate office produces the documents for me. I need to, we need to gather information, contact information, title commitment, contract, and then get the documents produced and over to you. So
on average, how much time do you need? Like, what, like, realistically would be, being fair to you, like, how much time would you think you would need?
In all the information I send out, I say, give me 7 to 10 business days, but we can do it in a few hours. But that's not the general rule, because it depends how busy we are and who we have to drop to the side that we're already working on in order to produce those documents.
And what is your charge?
Our fee for regular delayed exchange is $750. That covers the sale and the purchase. That's a non-interest bearing account. If they buy more than one property, the second or third property has a $250 fee. We use qualified escrow accounts, and the bank has a $100 fee for setting up that qualified escrow account.
And is that paid in advance or at closing?
It's paid at the closing, so it comes out as one of the closing costs. It'll be on the settlement statement.
And what happens if, like, their sale was to get canceled?
If the sale gets canceled, we have a cancellation fee of $200, but most of the time we don't even collect it. If we are, somebody gives us a rush that we drop everything for, it's kind of like almost a judgment call, because they give us a rush and then they say, oh, never mind. And we've already reviewed closing documents, done all this work. We might charge the $200 cancellation fee, but most of the time we don't.
Yeah, I'm just asking some questions which I actually know the answer to, but I just figured that they would, like I said, I've never seen you actually charge someone on a file that didn't go through.
Yeah, they're going to look for another buyer, right? So
exactly.
They come back.
At some point they're going to sell.
Yes.
Now, do they need to get an accountant involved as well if they're doing this?
It's not a requirement. However, I speak to a lot of CPAs and accountants, and they wish that their clients would at least let them know when they're selling the property, because their input is valuable. And many times there's issues that come up that, they're not going to think to tell us, and the CPA could be giving them some guidance. So it's not a requirement, but I always tell them, why don't you just call, let them know that you're selling the property, ask them how much you'd owe in taxes, if you just sell and don't do the exchange.
And okay, so for instance, let's say they plan on doing a 1031 exchange, the closing happens, they use you, the money goes into, into the account. So they find another property. What if they're not able to find another property during, let's say, the 45 days? Do you return the money to the seller, or what happens? How does that work?
Well, there's certain places where the funds can be released. Okay. If they identify property and we're past the 45 days and they go under contract and then the transaction fails, their funds may be held for the full 180 days. If they have other properties identified, IRS tells us we have to give them the full 180 days to complete the exchange. If somebody has closed starting and they get close to the 45-day deadline and they say, you know what, there's nothing out there. And I'm not just going to identify just to identify when I haven't even looked at these properties. They may decide and just say, I'm not doing the exchange. If they cancel prior to the 45 days, we return the funds to them, right away. They just have to give us wire instructions and we can return funds to them.
And everyone on here, as Dan Ramir mentioned before, like if you ever have questions, just reach out to her. Like she's really helpful. If your clients have questions, just call her, and she's definitely, from my experience, has always been available, always be able to assist with any questions. And just, the way it works is with a title company, any title, because a lot of people call me, oh, can you do 1031 exchange? Truthfully, any title company can do a 1031 exchange closing. With regards to the title company, it's no different than any other closing. It's just there's certain documents we have to get signed at closing, and maybe changes on the deed or whatever. But in reality, it's just like any other closing. The person you need to get involved is a company like Diane, who does the paperwork, who deals with the IRS and handles the money. So you definitely want to get someone like her involved. But truthfully, I mean, of course, I would love to do the closing, but I'm just being truthful. It's like it's no, it's not like anything special, like where certain title companies don't do 1031 exchange closings. On my end, it's just like any other closing. It's just maybe we have to get more documents signed at closing. And of course, as a title company, there's no additional charge if we're handling a 1031 exchange closing. Let me see if there's any questions.
And I have to say, it's such a pleasure to work with your office when we're doing an exchange closing, because everyone has the experience there and knows exactly what the process is. Thanks. And makes it a lot easier for the client to get.
I'll just add a couple of questions. I see. What if the client is looking to occupy primary residence, the investment replacement property?
Well, there is a way to convert the use of the property. So, when you're doing an exchange, the intent is that they're buying a property for investment or income production. Okay. The IRS has rules for, you never know. Goals change, things change up. And if you even have in the back of your mind that, I like this property, I may someday want to live in it. Their rules for converting the use of the qualified use of the property is that it must be rented out for a minimum of 14 days out of the first two 12-month periods. So that's over 24 months. And they have to minimize their own personal use to only 14 days or only up to 10% of the time it may have been rented in each of those two 12-month periods. I have a flyer that explains those rules in detail, but they cannot just move right into it. And the way the IRS is going to know that they adhered to these rules is because they have to report it. They should be reporting on their tax return. Oh, I rented it out for 3 months, 6 months, whatever, took some depreciation, and if they've done that over the 24-month period, and it's by 12-month periods, not necessarily calendar years, after that time period has lapsed, and they decide that, I'm not renting it anymore, I'm moving in, they can do that. Okay, there's no recognition of the gain at that time. It will still be there when they sell eventually, but it could be a strategy to get into a new home at some point.
And someone asked, I guess, the opposite. Like, so let's say it's their primary and they decide to rent it. How long do they have to rent it for before it's considered an investment and they could sell and do a 1031 exchange?
Okay, well, it's the same rules for converting the use of the property. But in that scenario, they need to look at what's more beneficial. So you got to look at what your primary residence exclusion is and how much gain you actually have in the property. So a lot of our properties in South Florida that, are homes that we've owned for a long time have way more gain than even the 500,000 exclusion you can get. If that's the case, then they need to move out of it, start renting it out. It has to be at least a minimum of 2 years, but until they're out of that 5-year window, it's probably going to be prorated. So, so that's important to, to talk to the CPA about how long they should wait before selling it and using it in the 1031.
Someone wrote, what if it's an apartment complex?
If it's an apartment complex and they're selling the whole complex, I mean, they're doing a 1031 exchange just based on value. If it's a multifamily and they live in one of the units, let's say, like simplified, say it's a duplex and you live in half of it. Well, if you qualify for the exclusion for primary, half of it is excluded from capital gains and you can do an exchange on the other portion. Okay.
Any other questions from anybody?
Okay, everyone. So I'm here. You can always, this is my cell phone number on the screen here. You can always reach me at that number, this 1-800 number here. That's for my team at my corporate office, where I have a number of senior exchange counselors. They're also CES, which is Certified Exchange Specialists. If you can't reach me and you have an urgent question, you can always call the 800 number. They are in California. So if you're calling me at 7:30 at night and I don't answer, they'll be answering because they're 3 hours earlier than us. Okay, so here to help you whenever I can.
Well, thank you so much. I really appreciate, definitely very important. Like I said, I really highly recommend, using her services if you ever come, or like I said, if you have clients who have questions, just reach out to Really. She's very helpful. She'll always answer your questions. Like I said, probably over 10 years, I've never had a bad experience. I've never had a client have a bad experience. So I definitely would highly recommend her services. As I said, Saturday, we were doing a short sale and foreclosure class. On Tuesday, we're going to do that top producer mastermind with Megan Romine. Tuesday, we're going to do that pies and Prosecco giveaway. And Wednesday, we're going to do that $1,000 cash raffle. So, thank you for your support. If you have any questions, even right now, if you have any questions about anything you're working on, someone asked if you speak Spanish.
Yo hablo un poquito español, pero no muy bien.
Okay. Ashley asked, was there a raffle? No, the raffle is actually on Wednesday. We're going to raffle off $1,000 cash. If you, like I said, my website is asktherealestateattorney.com. If you go to the website, you join the program, you will be eligible for the raffle. I know a lot of people I see on here, like, that are already in the program and will be eligible. And hopefully, someone on this, Zoom call right now wins it. So once again, reach out to me anytime, any questions, any help you need. I'm always available 7 days a week, really. And, yeah, I think she's posted the thing for Saturday's class. I'm going to do it at 10 a.m. Any last questions before we log off? No. Okay, so thank you, everybody. Have a great day.
Thank you.
Bye.
Have a great one. Bye-bye.